Timing the market is like driving your car on the streets of Delhi. Sometimes you'll get some really open roads, and other times you'll be stuck in traffic for hours.
अरे चलो ना यार.
So it's a case of good and bad timing, and while we understand that in the case of traffic, our own investing journeys are often consumed by the fear of getting it wrong.
So when I get back home, we'll discuss how even the worst stock market timers can get out of a jam and build a corpus of a few crores by following some simple steps. Let's begin.
At the time of recording this video, the Nifty 50 is at an all-time high of 18,500 points, which leads us to two questions that investors generally ask during such a time. A, should I book some profits now? And B, is it the right time to invest? I shall be focusing more on the second question in this video, but let's start by answering yet another question, that is, why do the stock markets generally move upwards? So why does anything increase in value? One reason is demand and supply, and we are seeing that now with the price of oil, transport and food at multi-year highs. A second reason that bumps up the value of an asset is the improvement in its earnings potential, and this is where the stock markets come in. You see, a stock is simply a representation of one's ownership in a business, and the primary objective of a business is to earn more profits for its shareholders. So as long as the business, or in a larger sense, as long as a majority of the companies continue to earn their earnings, the general direction of the stock markets will be in an upward direction. In fact, let's look at some data. The graph here shows the Nifty's earnings per share since the year 2000. Expectedly, there have been some good years and bad years, but the direction of earnings growth has generally been in a positive and upward direction. Let's transpose the Nifty 50 index values over these earnings numbers. Now, can you see the correlation? The trend clearly shows that in spite of frequent under and overvaluation, stock markets tend to mimic the earnings over the long run. Which means as long as the earnings continue to improve, there is every likelihood that the stock markets will continue to rise. So if you're an equity investor who's accumulating stocks or buying units in mutual funds for the long term, then in my opinion, there is almost nothing for you to get spooked about. Yes, you can be a bit cautious, you can buy a little less if you see the markets as overpriced and vice versa, but remember this, a stock market is nothing in itself, and every company that is listed on it is backed by a living and potentially thriving business that is dealing in goods and services in the real world and working extremely hard to earn a profit for its shareholders. As analytical investing is, it is also a behavioral exercise, which means anyone, you, me, will all get a bit nervous when the markets hit an all-time high. But is this fear really justified? So I went back to the Nifty 50 data to check how many times the index has seen a new high. It so happens that since the turn of the centuries, that is in the last 23 years, the Nifty has hit an all-time high in 65 months, which comes to an average of once every 3 months. Of course, an average is not the right way to look at it, and so I distributed those 65 months by their year of occurrence, which pleasantly revealed that there were only 5 years in the last 20 years when the stock markets did not reach a new all-time high. Now let's play the devil's advocate and build a worst case scenario. So say I am India's worst market timer and I invested my money only in those 65 months when the Nifty was at an all-time high. Which means my first investment was in February of year 2000 and the next was in December of 2003, November of 2004 and so on. At a fixed outlay of 10,000 rupees, I would have invested 6.5 lakhs and my corpus would have accumulated to a little over 23 lakhs, giving me a respectable annual return of 11.4%. But now let's keep the advocate aside and play the devil itself. So one of the arguments can be that my numbers are a bit exaggerated because of the massive bull run we have seen over the last 2 years. And however grotesque that accusation is, the devil does have a point. So instead of looking at the numbers all the way until 2022, I decided to shave off the last 2.5 years and examine performance until the 23rd of March 2020 when the Nifty hit a multi-year low. In other words, here's a person like me who has been buying the Nifty at all-time highs and has sold off everything on that fateful day of March 2020. Now that we all know what happened to the Nifty after that day, so this has to be the worst timing ever. And yet, in spite of having bought at all-time highs and having sold at a multi-year low, I would have still walked off with decent returns of 5.6%. The point is that lingering fear we have that I will lose a lot of money by investing at a high point in the index does not matter as long as we think in the long run. In fact, here's another proof of that, wherein I have mapped out how my returns would look at different all-time high points. So the measurement starts from February of the year 2000, which is also an all-time high, and the numbers I want you to focus on is from the year 2013 onwards. Notice here the rather stable return of between 10 and 12% that this all-time high portfolio has delivered in spite of having gone through many hiccups, including demonetization, GST implementation, the COVID lockdowns, etc. Now, I'm not suggesting that everyone should invest only at the all-time highs, of course not. But what I really want is for everyone to consider the bigger long-term picture of where you want your investment corpus to be in 10, 15, 20, 25 years from now. In fact, there is a cliche attached to what we have been discussing in this video so far, which is the time you spend in the market is more important than timing the market. It's a tune you'll hear from most investors, as we found out in our most recent video where Peter Lynch talked about having a long-term commitment to the stock markets. To sum it up, good investing is about developing a long-term investor's mentality. So play the long game, ignore the noise, learn more strategies like the ones I have been presenting on this channel. But remember, as long as the underlying companies and businesses continue to increase their profits, the stock market's march to reaching newer and higher all-time highs is likely to proceed relentlessly. I hope you found this video and the data presented a bit comforting, and if yes, then do share it with a spooked friend, colleague or relative. Once again, thank you for your time. Do subscribe to my channel, do like this video, and I'll see you next time. Until then.